as we all know, retail traders typically do react to these kind of markets. We saw it in the market today. CPI prints low, market goes up. And it's the kind of scenario that retail typically brings to the table. This is something we talk about here on our show quite a bit. This was an article from USA Today. Inflation comes off the 40-year high, but stays elevated, obviously at 8.5. Gas prices fall a little bit, but here we've got food and rent jumping as well. And then the core CPI not necessarily moving. So I look at this, and even though it is kind of, it's a good thing to be looking at this, at least in a downtrend. Sure, if we want good news, we could pick that out of the cherry basket and say that's a nice cherry. But the reality is the rest of the basket is still in big trouble. So with that being the case, and you look at the pressure that is coming into the Fed.
According to the latest inflation report from the U.S. Bureau of Labor Statistics, the U.S. Consumer Price Index jumped 8.5% in July 2022, compared to the same period in 2021. This has brought a much-needed relief to the stock markets, with top indexes, including this S&P 500 and NASDAQ, up by several points. The cryptocurrency market has also had its share of gains, pushing the overall cryptocurrency market cap above the $1 trillion mark. While certain indicators may suggest that the lower-than-expected inflation figures are responsible for the recent market rally, one market expert wants us to look beyond CPI, which he describes as a lagging indicator that does not really influence prices. In a recent interview with the Barron Network, American investor and fund hedge manager Mark Yusko discusses inflation, money printing, and how it all affects the cryptocurrency market. Please watch this video to the end as the Morgan Creek founder, CIO, and managing director gives an alternate but honest outlook on the current state of the U.S. economy. Also, ensure you hit the like button, subscribe, and turn on post notifications for more crypto-related videos. We deeply appreciate all your efforts in helping us grow the channel. Let's dive right in.
Growth is collapsing. Earnings usually follow growth. So it was just amazing to watch. And so, look, this summer, I don't know if you've been out and about, but this summer, no one's working. I mean, you and I are working right now, but everyone's on vacation. Everyone is gone. There's no volume in the markets. And when there's low volume in markets, you can get these kind of short, squeezy days on perceived good news. So you asked the question about inflation. CPI is kind of a silly number. It's massively lagging. It really doesn't have anything to do with reality. And I'll give you a perfect example. So over the last 2 years, really over the last 18 months or so, the Fed created half of all the dollars in the history of the Republic. 248 years, they created half. So theoretically, the dollar should have weakened about 50%, okay? And Bitcoin price should have risen 100%. Almost over the last 2 years, Bitcoin's up almost exactly 100%. Mm-hmm. And so it reflected all of the inflation that we were going to see over the past year in real time. So people who look at CPI numbers, they're looking in the rearview mirror. The road's already turned and they're about to fly off the cliff.
Well, and I think the point of that is that traditionally retail, as we all know, retail traders typically do react to these kind of markets. We saw it in the market today. CPI prints low, market goes up, especially around the August print. Now, the early September print that we'll get, what are you anticipating the Fed's position at the next FOMC?
In his interview, Mark Yusko also talks about the impact of interest rate hikes on inflation. According to him, the consecutive interest rate hikes of the past months have had no impact on prices. As such, they are not responsible for the drop in CPI. Instead, Yusko explains that we should be more focused on underlying issues such as the Ukraine war, China's zero-COVID policies, and the decrease in oil prices.
Broke the back of inflation like Volcker. No, he didn't. That decline in inflation has nothing to do with interest rates. It has to do with the fact that oil prices ran unnaturally because the Saudis flooded the market during the lockdown, collapsed the price of oil to negative. Remember, oil price went negative for a few hours. Then they rebounded from $40 to $120. And that shows up as CPI. Well, now oil prices are back under 100. They'll probably be back closer to 60 by the election. And over the whole period, oil prices will be unmoved and CPI won't exist. The other part of inflation print was used car prices. Raising the Fed funds rate isn't going to change the chip shortage in China. It's not going to change the
Right.
zero COVID policy in China. It's not going to change the price of wheat in Ukraine. It's not going to change the price of natural gas going to Europe from Russia, which is going to be, pardon my French. Although I said that once, Paul, and a French person said, "Why do you say that? We're not vulgar." I said, "I don't know why we say pardon my French, but it's going to be a shit show in the fall when temperatures start to go down and they're still buying Russian gas." So that's a long-winded way of saying what the Fed does really has very little to do with inflation, because what we're experiencing is not inflation. It's not demand pull inflation. It's not that we have excess demand and limited supply. It's we devalued the currency. I use housing prices here in North Carolina as the best example. Yep. Housing prices over last year went up 40%, 40 in 1 year. Did my house get bigger? Did it grow? Did it get more efficient? Did it somehow get better? No, it actually wore out. I had to put money into it to keep it at the same level. But what happened is the money that people used to buy houses got devalued because they printed too much of it. And the Fed isn't going to change the number of dollars in the world by changing the Fed funds rate.
Outside the traditional market analysts that really understand where the market is going, just like what we've seen here today, I was looking at Scott Melker. He put out a tweet saying 8.5 still super bad, but markets kind of care about this whole results versus expectations side of things. So obviously down expectation was 8.7, it came under, so we're going to see the number go up. And sure enough, those are the kind of scenarios to go in that rate. Now, with that, what you just said, the point being around the Fed, when you look at where the Fed has been over, gosh, I don't know, we'll look at this chart right here since 2008, which really was the last time we saw what was somewhat of a normal balance sheet, around 800 billion. And now we're running at 9.5 trillion. I mean, this is crazy upside right here. At what point does the Fed, how does this ever get corrected at any time?
It doesn't. It never does.
Still on the folly of the U.S. Federal Reserve, Yusko also talks about the central bank's promise to reduce its $9 trillion balance sheet. Data from Statista.com shows just how fast the central bank has been pumping money into the economy by acquiring assets. In 2007, the total balance of the Federal Reserve was less than $1 trillion. But now, just 15 years later, the central bank is carrying the weight of almost $9 trillion. Yusko compares what is happening now in the United States to what occurred in Japan in 2007. He explains that Japan promised to stop buying bonds and creating money out of thin air, but it has been doing the opposite, increasing its assets exponentially and causing a rapid decline in the value of the yen.
The whole markets, the whole economies collapse if you try to take that funny money, because it really is funny money. I mean, it's money created out of thin air. And part of it is, that's the plan. I mean, I hate to say it that starkly, but that has been the plan since 1913. The Fed was created to create inflation. Inflation is a myth, right? Inflation is not good for the average person. Think about it. If inflation increases a couple percent a year over a 25-year period, half of your purchasing power is destroyed.
Gone.
Why is that good for me? It's not. It's really good for the people at the tippy top. And it's why we have the greatest wealth and income inequality in the history of the world. And it's because for better part of 100 and some odd years, 109 years, the Fed has quietly been stealing the wealth of the masses and siphoning it up to the tippy top. And here's a factoid that no one talks about, actually makes me really angry. In the lockdowns, right, which may have, in hindsight, may have been the worst policy decisions global policymakers made in the history of policy. It's a big statement. But in that period, instead of things getting better on this front, $3.5 trillion with a T, trillion, 3.5 trillion of wealth went from the average person to the elite class, the owners, the super majority owners of these little tiny oligopolies. And that is part of the plan, right? I actually believe it was the plan all along. And it's kind of crazy that we all cheer for the Fed to bring us this inflation or tame inflation. Inflation shouldn't exist. It's not something we should hope for.
Yeah, I mean, the scenario has been one that I don't think a lot of people truly understand what's happening, with exception of true cryptocurrency people now that understand the alternatives here. I put out a tweet just before our show, and it was kind of just a breakdown. Hey, remember the Fed? Listen, it's owned by 24 prime brokers right now, not the American people. And this, the differences in the balance sheets, obviously uncontrollably short. Plus, you got over 100 trillion in liabilities right now with this. And if you look back at what Richard Fisher said, who was the Dallas Fed, this is the guy that pretty much said, we are in a shit show already. And he's been retired out of the Dallas Fed for quite some time. And he pretty much said, this is going to end badly. So how does this
Well, no, you're
not
exactly
end
right.
badly?
Well, the Federal Reserve is neither federal, right? It's not federal. It's not owned by the government. It's not a government agency. It has no full faith and credit. It is owned, as you said, by prime brokers and banks.
As Mark Yusko has explained, the system is completely skewed to favor only the rich and powerful. Neither the federal government nor the U.S. government truly represents the people. Their policies beggar the masses to enrich the wealthy, but their system is doomed to fail sooner or later. This is why many savvy investors are turning towards the cryptocurrency industry to securely invest in their future without fear of censorship limitations or having to place their trusts in the corrupt traditional financial system. Do you have thoughts and observations about Mark Yusko's honest assessment of the U.S. Federal Reserve? Please drop them in the comment section below, as we really love to hear from our viewers and subscribers. And don't forget to hit the like button and subscribe to the channel for more crypto-related videos. Thanks for watching.